Today's market moves weren't just a continuation of yesterday's rally. They reflected a subtle shift in how investors are thinking about risk, stability, and what actually matters over the next few weeks. U.S. equities moved higher again, but in a more measured way. The S&P 500, NASDAQ, and Dow all closed in positive territory, with tech leading the advance. At the same time, bond yields were relatively stable, volatility dropped further below the key 20 level, and the dollar was essentially unchanged. In commodities, oil rebounded after its recent pullback, while gold pushed to yet another high, an unusual combination that already hints at something more complex happening beneath the surface. So what changed? At the core of today's move was a shift in expectations around geopolitical risk, specifically the situation in the Strait of Hormuz. The early signs of a functioning ceasefire framework and resumed tanker traffic helped reduce the probability of a worst-case supply shock. In simple terms, the market is moving from pricing in a potential disruption to assuming that, for now, energy flows are being managed. That shift matters because it removes one of the biggest immediate tail risks, and when that kind of extreme scenario gets repriced, investors don't just relax, they reposition. At the same time, there's a second layer to this story. While geopolitical risk eased, the broader macro backdrop became more fragile. The latest downgrade in global growth expectations, combined with ongoing concerns around banking system stress and credit conditions, is starting to reshape how investors interpret economic strength. What looked like resilience a few days ago is now being viewed with more caution, less as a sign of acceleration and more as a lagging indicator before tighter conditions begin to bite. And that's where the market reaction becomes more interesting. Capital didn't simply move into risk-on broadly, it moved selectively. We saw strong buying in technology and consumer discretionary, but not in a speculative way. Instead, flows concentrated in what institutions see as durable businesses, companies with strong balance sheets, recurring cash flows, and pricing power. At the same time, traditional defensive areas in energy stocks were sold or saw profit-taking, even as oil itself moved higher. That divergence tells you something important. Investors are not positioning for a clean growth rebound. They're positioning for stability within uncertainty, prioritizing cash flow resilience over cyclical exposure. One open question investors are debating right now is whether this repositioning reflects confidence in a soft landing or simply a temporary pause while deeper risks continue to build. I'd be curious how you see this developing. Feel free to share your view in the comments, because under the surface, there are still fragilities that the market may not be fully pricing. One of them is the physical side of the energy system. Even if shipping routes remain open, storage capacity constraints in key producing regions could force production slowdowns, and unlike a temporary disruption, those kinds of supply adjustments can take time to reverse. At the same time, financial fragility hasn't gone away. Credit conditions remain tight, and any renewed stress in the banking system could quickly change the current narrative. So, while markets are stabilizing, that stability may be more conditional than it appears. And that brings us to the bigger picture. Today's price action suggests that markets are transitioning into a more complex regime, one where geopolitical relief coexists with underlying economic and financial fragility. Growth is not collapsing, but it's no longer clearly accelerating. Inflation pressures may ease at the margin, but structural constraints, especially in energy, remain. In that environment, markets tend to reward resilience, not optimism. Looking ahead, the next phase of this story will likely be tested by a few key variables. First, whether the ceasefire framework continues to hold and translate into stable energy flows. Second, incoming data on credit conditions and banking system health. And third, how central banks respond if growth weakens while inflation remains uneven. The broader takeaway from today's market reaction is that investors are beginning to shift from pricing extreme risks to navigating a more nuanced balance between stability and fragility. But markets rarely move on a single narrative. So I'd be interested to hear how you interpret today's signals. Are we seeing the start of a more durable stabilization, or just a temporary pause in a more complex adjustment? If you find this type of calm, analytical breakdown helpful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here.